to me, this is a setup for one of the biggest corrections in our lifetimes. And I mean, look at the 87 crash. That was basically one day. It led to a recession. It was south and the Fed started to ease right away. It's different this time. What's different is it's very similar to 1929, 1930. Everything's tilting lower. You mentioned bankruptcy, and what's the Fed doing? Ben Bernanke warned us when he wrote his essays in the Great Recession is they were pulling back in money supply, central banks on a global basis, right when they should have been adding. That's what they're doing.
According to the Organization for Economic Cooperation and Development, the global economy is expected to undergo a fragile recovery this year and next, as it grapples with the lingering effects of the COVID-19 pandemic and Russia's conflict in Ukraine. The latest economic outlook from the OECD highlights that the United States, Europe, and China will all experience relative sluggishness in their recovery processes. While the global economy is turning a corner, achieving robust and sustainable growth remains a challenging task. Persistent inflation and the restrictive policies implemented by major central banks to combat rising prices continue to pose obstacles. The OECD has projected a 2.7% growth rate for the world economy this year, slightly higher than the previous forecast of 2.6% in March. Additionally, credit rating agency S&P Global Ratings has raised its 2023 forecast for global GDP growth to 2.4% from the previous estimate of 2%, citing the near-term resilience of the global economy. However, the agency cautioned that the outlook for 2024 has worsened due to the prolonged effects of monetary policy adjustments on the economy. Mike McGlone, senior commodities strategist for Bloomberg Intelligence, shares his perspective on the global economic outlook, inflation, commodity forecasts, and the stock market.
Deflation now, I think, is the most significant in our lifetimes. Let's remember how we got these inflated assets. There was one key thing. Well, we locked down the world, locked down people, and then we just pumped the system with liquidity. Never have pumped that much system in this liquidity in the system ever. Money supply went up 40%. Condos in Florida, land in Indiana, and the stock market all went up 40%. I mean, that's just the way it was. Now all that's going away. Money supply is declining. Bank deposits are negative. So this is just a normal historical cycle of deflation. It's always in the back of too much inflation. And then the key thing is you look at yourself, so what usually stops it? Typically, you'll need a long and variable lag to central bank easing, Federal Reserve easing. And we still have most central banks still tightening. Last week we had the Fed, ECB, Bank of Canada a week before that, Bank of England, you name it, they're all tightening rates. With one exception, China, because China's have more of a secular decline. So to me, that's the complete trajectory. Inflation declining rapidly, PPI is actually tilting negative on a year-over-year basis, and interest rates still going up. Bodies in motion, interest rates going up, inflation dropping rapidly. And there's still one key missing link in that, and that's the stock market has to stay up. Because if it gives up the ghost like it normally declines in a recession, that's your three strikes for pretty severe deflation. The key point is I like to mention from our chief equity strategist, Chief Economic Strategist Anna Wong, is the Fed will be very reluctant to ease because of the sticky inflation numbers like personal consumption expenditures, employment cost indexes. Now, those numbers are still high, running around 5%, just below 5%. But see, the trajectory Fed funds are above those levels, and their Fed funds are heading higher, and those inflation numbers at the Fed are still heading lower. Bodies in motion, which are potentially going to accelerate. We're still fighting the Fed if you're long risk assets. Now, one thing I find very disconcerting, and this almost always happens in the biggest moves ever, i.e. 1930, is markets will go up into like a wall of hopium, thinking things will get better and ignoring the facts of history that stock market is bouncing into a recession has even started. You look like at the New York Fed estimate for recessions from the yield curve, it's at 70%. That's the highest it's been since 1982, I think. So you look at the yield curve, and then there's so many indications here that you're supposed to be very careful, yet investors are kind of double dog daring the Fed. And the bottom line is that's kind of the cat and mouse game. And that to me is just like the commodity market, what turned out to be its worst enemy. When it went up too much, it just squashed demand and brought on that supply, and everything collapsed and still collapsing. That's a problem. Crude oil's down another almost 2% today. The stock market is doing it in a different way by staying strong and into this hopium that we're only going to get a soft landing or no recession. It's keeping the Fed vigilant, which I think is going to aggregate things and make it worse. They're hiking rates well above their trajectory for declining inflation, which means just the normal cycles of don't fight the Fed are still don't fight the Fed. You look at Fed funds futures for the next money for July, they're still priced for 70% for a 25 basis point hike. And the key question I like to ask myself is what's the number one force that can stop the Fed and a lot of other central banks from still tightening? And that's the stock market rolling over. Until it does, the Fed's probably going to remain vigilant. There's your cat and mouse game.
According to Mike McGlone, the current stage we are in will be heavily influenced by market dynamics. He suggests that the Federal Reserve will adjust its course based on market conditions. McGlone believes that a significant decline in the stock market, particularly in the S&P 500, could serve as a catalyst for the Fed to change its stance. He asserts that a downward shift in the market is inevitable at some point. However, it appears that the Fed is reluctant to ease its policies unless circumstances significantly change. McGlone highlights that despite recent data showing disappointing figures such as lower than expected producer price index and retail sales, comments from Fed governors regarding potential rate hikes persist. He interprets these indicators as signs pointing towards a potential recession.
And you ask yourself, what's every central bank on the planet doing with the exception of China? They're all just trying to catch up the Fed. So to me, it's that power of the U.S. economy might be stronger than ever, certainly from a monetary standpoint. So if the U.S. tilts for the recession, the rest of the world has a strong, severe illness, maybe a cold. Maybe the U.S. gets a cold, the rest of the world gets gets COVID. I mean, this is just the way it usually works, but also they're so dependent on this demand pull economy. So the key thing I like to point out is I think it's illogical to expect just a mild recession after the greatest amount of rate hikes ever on the back of what caused those rate hikes, the biggest pump in liquidity that's dumping. So I fully expect just a reciprocal recession, just like we had in 08 and 09, like we had in 2000 to 2002, that area, and maybe in the 80s, which means a pretty normal drawdown in the S&P 500 peak to trough is 50%. It's done that twice in the last decade and since the beginning of the millennium. So to me, that's what I think we should expect. And also the bottom line is, David, the market completely is not priced for that. So as a strategist and a money manager, market's already priced for the stock market to go up a lot. It already has. If you look at the NASDAQ relative to its 200-day moving average, it's about 25% above that level. It hasn't sustained that high on a short-term basis, 200-day moving average, since the stock bond, the internet bubble. And so it's just an example of how expensive things are. You look at the Bloomberg Commodity Index right now, today on a 52-week basis, it's down 20%. The S&P 500 is up 20%. That divergence, how much never happens in a recession. So here's what we see. We have bond markets, inverted yield curve, credit crunch, commodities all pointing to recession, and the hopium of the stock market. So where's the risk there? Risk reward versus I think is that the stock market is going to tilt towards what's really happened for a recession, towards deflation. And to me, that's my base case. Now, if that doesn't happen, it's wonderful. But to some extent, you have to admit with the stock market up, and NASDAQ up over 30% this year, 38% this year, it's pretty well priced for a Goldilocks scenario.
This is alarming. When you see a stat like that, do you think that A, recession coming, or B, good buying opportunities for a lot of distressed companies?
Severe recession, unless you have a major pump of liquidity and some significant action to help arrest that trajectory. So bankruptcies are increasing, right? That's just getting started. Despite the economy expanding well and the lowest unemployment in 60 years. Picture yourself 12 months from now, David. What's going to make that trajectory stop? Typically, it takes a massive amount of Federal Reserve easing and a decent lag to that easing. We haven't even got to that point yet. So that's a key trajectory. I'm glad you pointed out. That's a deflationary trajectory that shows no signs of stopping until or less we have some signs of liquidity pumping from the Fed. And typically when they start pumping liquidity, it still takes probably a year for bottoms in most risk assets. So what I think you see pointing out there is just the beginning of one of the greatest economic resets of our lifetimes.
Foreign ministers from the BRICs group of nations gathered in South Africa to call for a rebalancing of the global order, shifting away from Western nations. The BRICS vision, as articulated by South African Foreign Minister Naledi Pandor, aims to provide global leadership in a world marked by geopolitical tension, inequality, and global insecurity. However, discussions were overshadowed by allegations of Russian war crimes in Ukraine, leading to an arrest warrant being issued by the International Criminal Court for Russian President Vladimir Putin. BRICS, consisting of Brazil, Russia, India, China, and South Africa, is seen as an alternative to the G7 group of developed nations. With a combined population of over 3.2 billion people, comprising about 40% of the world's population, the BRICS countries seek to address the problem of economic concentration that leaves many nations at the mercy of a few. During the meeting, there was a call to send a strong message that the world is becoming multipolar, and that new situations cannot be addressed using old approaches. The BRICS alliance aims to build a multipolar world order reflecting the needs and aspirations of developing countries, as stated by Brazilian Foreign Minister Mauro Vieira. Chinese Vice Foreign Minister Ma Zhaoxiu highlighted the potential for the group to expand and offer assistance to developing countries and emerging market economies. However, the sustainability of the BRICS notion of independence from the US dollar remains a subject of discussion, with the alliance seeking to reduce reliance on the dollar and embracing de-dollarization efforts. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.